Welcome you all. Now we will discuss a brief on employee stock options. What is employee stock option? See, employee stock option allow employees to own shares of the company where he is working. See, these are the form of compensation that companies offer to their employees, giving them a right to purchase shares of the company at a predetermined price at future date. And this is not an obligation. ESOP is this is an option to the employees. What is the purpose of ESOPs and what are the objectives of the ESOPs? See, the primary objective of employee stock options is to align the interest because you are giving ownership to the employees. See, other objects includes the compensation for employees, employee retention, motivation and performance alignment. With this, you are motivating the employees and wealth creation for employees by giving at lower price, and definitely the company is creating a wealth to the employees, attracting and retaining talent. So with the employee stock options we can attract the employees, we can retain the employees, promoting a collaborative culture because both together work can work, and employees also feel like they are the shareholders of the company. How do ESOPs work? There are three stages. The first stage is grant stage, second stage vesting period, vesting stage, third stage is exercise. See, what is a grant? So when company is giving options, it give a letter in the form of grant. Employees are granted the right to purchase company shares at set price called exercise price. So in the first stage, company will give a grant letter. And the second stage is a vesting. Employees need to wait a certain period. The minimum vesting period is 1 year, and it may go up to 5 years in the practice. It is depends on the company. Company will take a decision. Company means nomination, remuneration committee, compensation committee will take a decision. What would be the vesting period? But as per the law, minimum vesting period is 1 year. And the third one is exercise. So after the vesting period, then then the employees can buy the stock at predetermined price. That is called exercise. Employees will exercise the options. Then next, it is key terms of the ESOPs. These are some technical terminology should be familiar. What is the grant date? The date when the options are given to employees. And vesting period. The time of employee must wait before vesting their options. This is called vesting period. Minimum vesting period is 1 year. And types of vesting, no time-based vesting, performance-based vesting, hybrid vesting. So some companies will say you wait for 1 year, you get 20%. And you wait for another 1 year, then another 30% you will get. Wait for another third year, then you will get another 30%. So then last end of the 4 year, another 20%. So total 100% you will get. So this way, this is time-based investing, performance-based investing. So the company may say, yes, you do this, you get this. So this is what performance-based investing. What is the exercise period? So after vesting also, then there is a exercise period. Some companies will say within 2 months you have to exercise the options. Some companies will say after vesting you can exercise up to maximum 2 years. So it depends on company to company. Exercise price is the price at which the employee can buy the shares. Usually it is the below market price. Otherwise, why employee will take at a higher price? So usually the exercise price will be the below market price. Then only the appreciation will come. That is the benefit to the employees. That is treated as a perquisite in the hands of employees. The ESOP scheme is meant to motivate and to incentivize new employees as well as the employees who have contributed to the growth of the company in the past, to retain old employees and motivate new employees, and to motivate both new and past employees, and to offer them an opportunity to participate in and benefit from the company's future performance. thereby acting as a talent retention tool, as well as align the efforts of such talent towards long-term value. See, long-term value creation in the organization. So finally, we can say that talent retention tool. Salient features of ESOP scheme: stock options granted to the employees. Employees can buy shares at predetermined price. And vesting period and exercise period, we have discussed now. And conditions for exercise also we discussed now. Then what about the taxation and tax implication? See, pay the exercise price, you buy the shares at exercise price. Then ownership, you now own the shares. Once you get the shares, then you are owning the shares, which you can hold or sell later. Tax implications, you will pay tax and on the difference between the exercise price and market price when you exercise your options, because it is perquisite in the hands of the employee. So here, 2 times you have to pay the tax. That is, employees have to pay the tax at 2 times. One is at the time of exercise, the difference between exercise price and the grant price, that is a profit. And that is based on the slab rate of the individual employee, that is a taxable. And at the time of sale, so you can keep the shares, no need to sell immediately. So when you are selling the shares, then it will become a capital gain. If you are immediately selling, short-term capital gain, and you are if it comes under long-term capital gain, so according to tax law, then this will be taxed as a capital gain tax. Then legal framework governing ESOPs. So here we have to see of 3 acts. One is Companies Act, Section 62 1B, provision for issue of shares under employee stock options plans, that is 62 1B of the Companies Act 2013. And another SEBI, Share-Based Employee Benefits and Sweat Equity Regulations 2021, applicability to listed and proposed to be listed companies. And another one, Income Tax Act 1961, because the taxation will come, no? Taxation of ESOPs at the time of exercise and at the time of sale. This is a brief on employee stock options. Thank you.